So before we discuss this super important chart, let's firstly look at this. The Buffett gap, as we call it, returned earlier this year as Warren Buffett's firm Berkshire Hathaway underperformed S&P 500 again, just as it did before the massive dot-com crisis in 2001. The pattern is always the same. Berkshire, which typically outperforms S&P 500 by a lot, recently underperformed because of its defensive stance, favoring cash over stocks. By March 2025, Berkshire Hathaway had built up a record $347 billion cash pile after selling more stocks than it bought for 11 straight quarters. Fast forward a few months, and the trend has turned. Buffett has deployed $3.9 billion into 12 stocks, with new positions in UnitedHealth, Allegiant, and Lamar Advertising, alongside heavier bets in existing holdings like Chevron and Lennar. This move signals a sharp change in posture, from hoarding cash to aggressively buying stocks. What we usually do at Glennius is we look at the overall market environment, especially the macroeconomic factors. Just to name a few factors, the markets are overheated, overpriced relative to the S&P 500 to money supply ratio, and index performance has become heavily concentrated in just a few AI and tech giants. We try to price rather than time purchases, Buffett wrote in his 1994 letter to shareholders. When you compare the historical durations, bull markets have lasted anywhere from just a couple of years to over 15 years, while bear markets tend to be short and sharp, averaging little more than a year. That variability shows there's no fixed lifespan for expansions, and since the current bull run is far from being the longest on record, history suggests it could still have room to continue. Just so you know, no part of this video should be considered as financial advice or investment recommendation. If you follow closely Buffett's moves, you'll notice Warren Buffett's approach to investing can be boiled down into a few principles. First, investing with a margin of safety. Imagine a chart of intrinsic value as a steady line, and the stock price moving up and down around it. Buffett waits for those dips when the market price falls well below intrinsic value. That discount is his safety cushion. Just like UnitedHealth dropped heavily in recent months, essentially passing the growth-adjusted valuation test with a PEG ratio of just 1.24, meaning the stock is attractively priced relative to its earnings growth prospects. Second, avoiding speculation. Instead of chasing spikes on a chart or reacting to market noise, he looks for steady, long-term fundamentals. Earnings growth, return on equity, cash flow. Those are the curves that matter and not the day-to-day price swings. Third, viewing stocks as ownership in real businesses. And this is central to Buffett's philosophy. When he buys shares, he's thinking about factories producing goods, employees generating value, and customers later paying for those products. That's why he often contrasts productive assets with unproductive ones. This is also the reason why Buffett isn't a fan of assets like gold and crypto. Those assets are sometimes considered dead money. It doesn't create earnings, hire workers, or reinvest in growth. We mentioned the Dow to M2, stock cap to money supply ratio. When we talk about the Buffett effect, UnitedHealth in 2025 is about as clear an example as you'll find. The Dow Jones Industrial Average is a price-weighted index, meaning big, expensive stocks, like UnitedHealth, can swing it much more than smaller components. For months, UNH was the single biggest drag on the Dow. The chart shows it sliding more than 50%, while the Dow itself kept grinding sideways. Then, Berkshire Hathaway disclosed its new stake. Overnight, the sentiment flipped, and now we're seeing UnitedHealth surged over 20% in August alone, instantly erasing a chunk of its decline and adding more than 300 points to the Dow. That single company, once the anchor weighing the index down, suddenly became the force pushing it higher. Another very important point is that Michael Burry recently invested in UnitedHealth as well. This naturally puts him in rare alignment with Buffett, even though the two are usually viewed as opposites. Burry became famous for betting against the housing market ahead of the 2008 financial crisis that earned him hundreds of millions of dollars. Seeing these two very different styles converge on the same stock gives extra weight to the idea that UnitedHealth may be undervalued. Buffett's Berkshire Hathaway recently disclosed a stake worth more than $1.5 billion, representing about 5 million shares. This is his first significant purchase after 11 consecutive quarters of net selling, which makes it stand out even more. Burry's Scion Asset Management, by comparison, bought around 20,000 shares, a much smaller number but consistent with his portfolio structure. Scion currently holds only 6 positions, a stark contrast to Berkshire's 42-stock portfolio. UnitedHealth's appeal is clearer when you look at the numbers. The stock trades around $300 per share in August 2025, down from $600 a year earlier. a 50% decline in just 12 months. That collapse has driven the price-to-earnings ratio down to about 13, the lowest in more than a decade. For context, UnitedHealth has typically traded closer to the high teens or low 20s on a PE basis. The sell-off stems from surging medical costs in 2025, particularly in its Medicare Advantage plans, which have pressured profits. Yet the company remains the largest health insurer in the United States, with millions of members and a diversified business. Buffett and Burry likely believe those fundamentals will outlast the current headwinds, making today's valuation an attractive entry point. As always, this is not financial advice or a recommendation to buy or sell. We provide you with our view and take on macro analysis with regard to the markets. Thanks for watching. This is Glennius.